The secret formula really is to be value-based, to get good employees who also believe in your values and the culture, and to make business simple.
Ajay Piramal, one of India's top industrialists. Through his investments and acquisitions, he created a business empire worth over $10 billion. Today on Managing Asia, we meet the chairman of Piramal Group. He's called a contrarian, a top industrialist, the savviest rainmaker on Indian Deal Street. Ajay Piramal has grown a conglomerate valued at over $10 billion US, recently winning him CNBC's ABLA CEO of the Year award.
And I am thankful to the jury and CNBC for this. Thank you. I look at business as a force of good, to do things and to change the way society is. And the only way that you can make a big impact, I think, in society is that if you create wealth through business and then spread it around.
Piramal has struck gold by taking the path less traveled, deftly changing focus for the group over the years, from pharmaceutical to healthcare to now real estate and housing finance.
Yes, I am a contrarian because I really feel that that's where value can be created. If you're going to do what everybody else does, then there will be a highly competitive environment and you can't get the best. So if you need to get good deals, if you want to enter into businesses, one has to look at it differently.
He began his career in the family's textile business at the age of 22. That was in 1977. But shortly after, his father died, followed by his elder brother, leaving him in charge of a company crippled by union strikes. Piramal shifted course by jumping into drug making and got lucky. Your first big bet was getting into the pharmaceuticals business way back in 1988. You bought Nicholas Laboratories, which essentially changed your fortunes. In your mind at that time, was it a big gamble getting into a business many multinationals were trying to get out of?
It was a gamble, but I think I really feel sometimes I feel blessed that I do things and it just turns out to be good.
Well, what did you know about drugs and pharmaceuticals back then?
So really nothing much about that, and it's really very different from what textile business is. They are really like chalk and cheese. In pharmaceuticals, it's a branded business. It's all about selling products. It's all about technology, intellectual property, where manufacturing is not as important as it is the sales, the marketing, and the product development and quality. Textiles is all about manufacturing. There was not much. It's a commodity business. Also, I remember textiles are very old conventional business. Pharmaceuticals was much more multinationals. The company that we acquired was used to multinational culture. So it was different, but I think it was fun.
In 2010, in a high-profile move, he sold it off in what some saw as the mother of all deals. In 2010, you sold the pharmaceuticals business to Abbott Industries for $3.8 billion. You sold it at a time where Indian pharma was projected to grow at a rate of 15 to 16%. Was it all about timing for you?
It was about timing, and it's really about the contrarian approach that you earlier talked about. Because at a time when 2010 was a time when every multinational wanted to expand into India, wanted to grow. And when all of them want to go, then obviously we realized that there was a huge value that we could get for our business. And also, it also means that the future would be much more difficult because there would be much more competition. Also, the other thing is that we could see actually dark clouds on the horizon in terms of more regulation. And therefore, it was, I think, again, a challenging decision to take. We were in it for 22 years. We had built a company. Nicholas, when we acquired it in '88, was just ranked 48. In 2010, it was number 3. So yes, it was a challenge, but not as much while you sell it. Because again, I and actually my team looks at our role is as trustees. We have to do what is in the best interest of our shareholders, We have to do what is in the best interest of our employees and our customers. And we felt that if we sold our business to Abbott, it would be in everybody's best interest.
Well, these days you haven't quite exited a pharmaceuticals business. You're going aggressively into the OTC, over-the-counter drug business. You also have a very lucrative contract manufacturing business where you support trials and drug developments of other companies. What does it take to win in this highly competitive, not to mention highly regulated healthcare market?
It is a very difficult market, that's for sure. But I think, again, our understanding of the market and the good people that we have, at the end of the day, it's the people that make the difference in whichever business you're in. I think we have good people. We also have a good brand, which attracts to, which we can attract, first of all, good people, good partners, whether it is people who provide technology or do distribution for our products, and customers as well. So it's a combination of all this which helps us to do in a very challenging market.
Well, given the competition out there, are you facing any margin pressure?
Well, margin pressure is a constant battle that you have to undergo, and that's the job of management, to see how we can give really value to our customers so that a margin is not such an important issue, and then continuously be more productive, be more efficient so that the costs go down.
Pharmaceuticals is now the biggest segment of your company, pulling in close to half of last year's fiscal earnings. Where do you see further growth from here? You're likely to make any more acquisitions in this space?
The way we look at any business of ours is, and especially pharmaceuticals, we grow both organically and through acquisitions. So we invest in technology, we invest in processes, we invest in people on the one side, but we also do investment in acquisitions. So that's how we've grown till now, and we will continue to grow in the same way.
What are you looking to acquire?
So, you know, the way we look at acquisitions is that, first of all, there has to be a strategic fit into our business, what we have. We have certain plans, and whether it fits into it, then again, is there some value that we can get out of it? And that's why most people say that almost, 75% of acquisitions don't work out. But I think we've been very fortunate. Almost 90% of our acquisitions have been created value for our shareholders.
But looking at the pharmaceutical portfolio that you have, is there anything missing in there that you want to buy?
We are happy with the areas that we are in. So we are in OTC, we are in contract manufacturing and services. We also market and manufacture and sell critical care products which go into the hospitals globally. So we will keep adding on products, but the broad range of areas that we are in, I think they are good enough for us.
Well, these days you're focusing on expanding your financial services business, where you're moving from wholesale to retail. You've recently entered the housing finance space, especially at a time when the government is placing a lot of emphasis on affordable housing. You've hit a sweet spot. Is this boom time for you? Financial
services has been a good business for us. We started this business only in 2012 and actually started seriously in 2014. In the last 3.5 years, we've grown it to become a very successful business. And I think that's also because the environment is right in India. In India today, we have good GDP growth rates, and normally it says that financial services grows at 2.5 times of what's the GDP growth. So if you have even a 7-8% growth in India, to grow at 20% is the average. The other thing is that in India, almost 70% of the market has been controlled by government public sector banks. And they've been going through some challenging issues of NPAs, and therefore it gives us a space to enter in. And housing is definitely for the future. The thrust is, as the economy grows well, the government is also putting a lot of emphasis on housing. So we think it's a good space to be in.
But speaking of housing, there are more than 70 housing finance companies in this particular sector alone, fighting for this $1.3 trillion market. As a new player, relatively new player, what are you doing to battle bigger rivals like HDFC for market share?
So of course, there are much bigger players than us, but there are not that many big players. Actually, you will be surprised that amongst all these 70-odd players, there are only 10 players who have a book size of more than $800 million. So it's not as big, and there will always be competition. And that's what in every business that we've been in, we've entered when there are several competitors. And still we have a role to play.
Do you aim to be number one in the housing finance space?
I don't think we can be. That's not realistic, because there are others like HDFC who talked about who've been there before, but we will be amongst the leaders.
You have a significant investment in Shriram, where you sit as chairman. They're in a retail space. Now, after 4 months of negotiations, the merger between Shriram and IDFC has been called off. What happened? What was the problem?
So frankly, the merger between these two companies is, as somebody told me, that they've rarely seen discussions where both sides are unhappy with what would have been the outcome. And therefore, it was called off because the valuations were different. I think Shriram has really certain unique capabilities which nobody else has. In Shriram, we have two different companies which are listed, which give loans, one to small and medium scale industry, and the other really is the leader in used commercial vehicles. Shriram has created a unique, there are more than 20 million customers in the whole fold of Shriram. I think these are very strong advantages. It's a very good franchise. We employ more than 60,000 people all over the country. So it is a good franchise which on its own can grow as well.
You're not disappointed that the merger didn't go through? It's not a big setback to your financial services business?
I don't think so. In fact, I think this will just spur us to do more.
The financial services business is now your fastest growing segment of the company, accounting for something like 40% of revenues. Could it eventually overtake your pharmaceuticals business from here?
So if you look at profitability, it's already ahead of the pharmaceutical business. And as I see the future, the growth rates in financial services are going to be higher than that of pharma.
Could financial services overtake your pharmaceuticals business this year?
I think there's a good possibility to do that.
What sort of loan book are you looking at for your financial services to achieve that kind of growth?
So today the loan book, it's only on the Piramal loan book is about $6 billion. I think we will take it, our aspiration is to take it to about 15 billion towards the end of 2020.
Don't go away. More with Ajay Piramal, chairman of Piramal Group, in just a moment.
The real estate market is going through a big churn. The big changes that have taken place, demonetization, the RERA, as well as the GST, all these have made a big change. 80% of the developers may not survive this.
Managing Asia will be right back. Hi, I'm Christine Tan, and thanks for watching Managing Asia on CNBC Live. You can check out more of our great content by clicking on the videos on screen. And don't forget to subscribe to our channel for the very best in feature programming. Thanks for watching.